All right, ladies and gentlemen, welcome back to another episode of the Market MadHouse Show. My name is Cyprian Francis, and with me, as always, co-founder of Madison Trading House, Mike Patton. Good morning, Mike.
Good morning, Sip, and good morning, everybody.
Today is the last day of August, right? So we're getting we're
Yeah,
getting back to business here, and since our last discussion,
right.
we were basically setting up for the Jackson Hole news, right? And we debated whether it would move the market or not, and it certainly did move the market to the
it did.
downside.
It
What
did.
are your thoughts on everything that took place there?
Well, so as I mentioned, we would have to wait and see what people had to say. But Powell's speech was actually published at the time he did it. They were publishing the comments as they were going. So, Chairman Powell, the chairman of the Federal Reserve Bank of the United States, which of course is the most important central bank in the world. Second place would be the European Central Bank. But basically, Powell was very, very, very blunt about inflation is the enemy, price stability, meaning that we need to calm down inflation, is the main objective, and everything else is in the background. He made no, he didn't mince words. He didn't act like maybe, possibly, we might reconsider. It was very, very blunt and direct. And basically, what he told the markets is that, look, if we have to suffer pain to get this inflation under control, that's what's going to happen. We're going to suffer. And they said we will. There will be slow growth. The economy might slow down. Unemployment will probably go up. I mean, these are all things that he was very clearly saying, well, we have to do it. If we don't do it, he said that's going to be an absolute disaster. So, in short, those were his comments, and other central bankers were in agreement. So once Jackson Hole ended, everyone came off with a more hawkish note, and every major central bank is talking rate hikes. Now, China is probably the only central bank out there that I think is looking at cutting rates to kind of stimulate the economy over there. But other than that, all the Western governments are definitely on the raise interest rate bandwagon. So the markets definitely didn't like that, and we took two major dives in the S&P 2 days in a row. Right now we're slightly up, but we're still under a lot of pressure as we speak. So if I jump over to the dashboard here to the SPY, okay, so you can kind of see this is the 26th, right? So that was basically when this was after the day of the comments is when this was, and we just boom drop, and then we drop again, and here we are today, or sorry, here we are on the today 31st. So in short, not looking too good, guys. Looking like the markets are really going to be under pressure for a while. Not surprising. So the markets were hoping that Powell would take a slightly softer tone and a more balanced tone, but based on the way he said it, it's pretty obvious we're going to be seeing rate hikes for a while to come. He also made it clear that the range of rates, between like it was like 250, 2.5% or whatever, is somewhere in that neighborhood. He's like, yeah, that's not too high, and that's not something we should be expecting. That's where we're going to stop. He's making it very clear we could go quite a bit farther than the 2%, 3% range of interest rates, and the markets definitely don't like that. So as a result, we've been selling off, and there are some other numbers I'll go over a little later. But yeah, it's Jackson Hole basically was a massive disappointment to the markets, and now we're back on the negative trajectory of the market.
And so the next rate hike or the next rate decision is in September. Is that
September.
correct?
Yep.
Yeah. All right. So that is a little bit of a precursor to seeing that information. In addition to moving inflation and what has an impact on inflation, we had oil numbers this morning
Right.
that don't really help the case. Is that correct?
That's correct. So it would be better if oil inventories were building up because that would depress oil prices. But instead, we see the exact opposite. Oil inventories are continuing to sharply decline week after week. Now, on top of this, remember that we've been selling oil from our strategic petroleum reserve for a while now, And I guess the objective has been to try to suppress oil prices by putting more petroleum onto the market. And of course, that petroleum is being sold to other countries such as China. And interestingly enough, a lot of that oil ends up going to the hands of people who are saying, we're not going to do any Russian oil. But then, our strategic petroleum is up in their hands. Long story short, a couple things that we have to take away from that. Number one, if we're depleting our strategic petroleum reserve, which is there for that reason, the strategic petroleum reserve is designed to help us in the event that there's some sort of disruption of oil production. If we're depleting that, we have to replenish it at some point, which means that future demand for oil is already built in from every distribution we do, means that there's something that has to be collected later to replenish it. And I'm assuming they will eventually do that at some point. So I think that program's supposed to end in October, where we keep sending out more oil. So that means that we have already a pressure point that's going to come into the markets in the fall. We also have the larger than expected demand going on globally for oil. So in short, oil prices are likely to go up going into the fall. And as a result, that means that prices of everything go up with it. So, unfortunately, yeah, there's no relief coming from oil. The prices are still going up. And if we add on top of that energy prices as a whole, especially when we look at Europe natural gas, I mean, at the pace things are going, um, globally, energy prices are going to be quite high this fall. They're already high as it is, and they're probably going to go even higher. And that's going to have a very negative impact on the economy. It's the worst case scenario: inflated prices and stagnant growth, stagflation, which is what we're looking at. So the Fed is correct that they have to take immediate, strong action now. But even with that strong action, it may not be enough to stave this off. We may be looking at some pretty difficult next, 3 to 6 months or more for the global economy, mostly, in the western part of the world.
Yeah, so we're definitely keeping an eye on oil. We're keeping an eye on the Fed rate decision. And then another topic that we've discussed a few times that does have an impact on inflation is just the happenings in China, right?
Right.
Because they are a major supply chain provider and they keep shutting down. So they're having some sort of a conference to discuss, their mandates and whatnot.
Yeah. So it's not just discuss mandates. They have their national congress, which will be announced for the 16th. I believe that's actually earlier than they usually do. So that kind of shows some urgency there. But basically, they're going to discuss a large number of topics. So this is just China. This is their national congress of the Communist Party of China. They bring together all the leadership, and they basically talk shop. And so it's kind of like Jackson Hole where Jackson Hole's for financial people. This is just a national congress for China. Now, one of the topics that will definitely be brought up is the zero COVID policy. The question is whether China can continue to maintain this policy and sustain its economy. China's going through a lot of difficulties right now. They have debt crises, from mortgages and things like that. The housing crisis is a big deal in China, because it's been so hot and overdone for so long. Then you have droughts, record droughts, heat waves. I mean, they're just having a lot of different issues that are affecting them all at once. So I think that the leadership probably is going to look for some way to relax this policy. But there's a catch here, and the big catch is if they relax the policy and COVID-19 gets out of hand, ultimately it's going to hurt them later. So it's like they're kind of stuck in a place where they can't go anywhere. In my opinion, it's just in my opinion that's one of the reasons I'm actually glad. Not to say that people dying of COVID is a good thing, but I'm kind of glad that in the Western world it got out, because now we're actually at a point where we can deal with it. We can live with it. If you haven't had that big wave pass through your country at least once, you're not ready for it. So China is definitely not in a position where they can have, shut down their half of their economy and they're still going to be okay. They need to basically moderate it. So maybe they'll come up with an alternative plan. Maybe they'll have some places open, let it spread there, and then deal with it later, and then let another place open. We don't know. So, in short, the world is going to watch that, and if they make a more open policy where people are able to do more, manufacturing is not as interrupted, etc., that should be good for the markets. But I don't think that at this point it's going to be enough to save us from the current problems that we have. So, I think it will be a mitigating factor to slow down inflation and make things a little better, but it's not going to solve it.
Yeah, it's kind of crazy to think about like everything that we've gone through in the US with the shutdowns and all the money that was printed, and we've kind of got a hold on it, but there's the population in China is like 4 times the size of the US. And so I
Yeah.
mean, and they've got remote places and they're, still kind of in this old school type of government. So you're right, like there's definitely something to keep an eye on there, and hopefully they come up with some solutions because that will help the global market, the global trade, supply
Right.
chain, right? Getting back to normal.
Right.
Wonderful. And then let's just cover real quick some of. I feel like we have a light week on the economic front, right? Like we haven't gotten much news. I know we had some consumer confidence yesterday that was positive, but like, does that really mean anything?
I was surprised. I actually was surprised at that consumer confidence up. I'm like, really? What happened? Like, what are
Over a
these?
hundred is usually like a very optimistic,
Yeah,
report.
yeah. I don't know what these people are thinking, but I'm like, wow. I guess maybe I'm missing something. But yeah, consumer confidence beat expectations big time. 103.2 versus 97.6 expectation. Previous one was 95.3, which was less than expected. Jolt's job openings actually beat expectations too, 11.24 million versus an expectation of 10.37. So this is the second time in a row that Jolt's job openings have beat expectations. So I mean that's a positive thing.
So that
But-
means there are more jobs, which means there are more opportunities for people to earn, which should keep the market up unless those
Well,
wages.
no, I disagree on that for one reason, and here's why. Normally, that would be a good thing, but in the context of now, since the Fed is basically telling us that employment is too high, like we have too many people working, we need more unemployment. So every time we see, I mean, I guess technically, job openings does technically mean you need more people, but
So
I
let me
think the
ask
mark.
this. Let me ask this question, and
Hmm.
this is just an outside thought. If we improved our immigration, right? If
Hmm.
we allowed more people to come into the US to fill those jobs, would that help the overall economy?
It could possibly, but it depends on what jobs are open and if the people coming in qualify for them. So that's really the issue. Like opening up more immigration doesn't necessarily mean those jobs get filled if those are not the jobs that the people coming in can do.
So those
So
are
it
two
depends.
arguments. It's like we got a lot of jobs, but these are jobs that nobody wants.
Or yeah, if they're jobs that no one wants, possibly. But that's what I'm saying. We don't know if these are jobs that no one wants. We don't know. It just says 11.2 million. But I will say, sorry, yeah, 11 point something million. But basically, they did say this is an inflationary pressure showing that the labor market is still tight. And that's my point. Like when I'm reading this summary, that the more job openings we see, the more inflationary pressure that is. Because if you think about it, if there are a lot of jobs open, you have a lot of supply, not as much, and everyone's working. So that means only to get someone to move from one place to the other, you got to offer them more money. I mean, you got to give them more of something. When I used to do recruiting in the past, briefly for like 1 year, year and a half, and I remember that was a major thing when you have a lot of people working, but there's lots of job openings and people want those job openings filled. There's only one tactic. Like you just have to tell the employer, listen, if you want somebody, you're going to have to pay them a lot more. That's it. If you don't do that, they're not moving from the place they're at because the place they're at is already paying them well. is already giving them all the benefits because they don't want to lose them. So right now we have a very interesting job market because a lot of people can quit and easily find another job. A lot of the clients that members that we have, they are some of them who have regular jobs. They're just saying, "Hey, I'm just going to look for a better job," and they'll probably find one very quick. I do have a concern though about this, and I've voiced this before. I have a strong suspicion. I'll just call it a suspicion that when things turn, it's going to turn so fast that a lot of people who are on the job hunt now, expecting to get an easy new job, suddenly are going to find that maybe these people aren't hiring. And here's why I believe that. We just saw a huge, massive miss on ADP non form employment change. They were expecting a lot more people, a
Yeah, so
bigger.
here I'm looking at it. Previous 268,
Mhm.
actual 132.
Yeah,
So
way
so
below.
about half. It missed by like almost 50% of its median forecast.
Yeah, so basically, the last reading was 128. The forecast was 300. We get 132. So this is showing that hiring is cooling off. Now, this could be just a one-time thing. Some analysts have pointed out that August numbers tend to be very volatile. Okay, that's fair. If we see this happen again the next time and the next time, then everyone's going to say, "Oh crap, this is really slowing down." I do think, though, factually, I do think things are slowing down. I have a lot of anecdotal evidence, from personal experience that suggests that hiring is not really, people aren't pushing to hire as much as they were before. I'm seeing fewer help wanted signs. A lot of places that were offering jobs are not at this point. So I do think that we're probably seeing a transitional phase where companies were desperate to hire, but now they're not because they don't see the economic benefit of doing so at this point. So, I mean, at this point, I'll say that we may be seeing a very sharp transition soon. Now, how that's going to affect the markets, it's hard to say. But if companies aren't hiring, that basically means they don't see business growth. So that should have a negative impact on the economy, in addition to what the Fed has to do. But what the markets are scared of, going back to what Powell said, is Powell didn't seem like he was in any way going to budge if people lose their jobs and the economy goes through a rough spot. He's not acting like, "Hey, we're going to focus on that." He's just saying, "No, the enemy number one is we got to take out inflation. We got to stabilize prices, get inflation down to 2%, and if we can't get it there, then we got to keep going." And that's what he basically said, by any means necessary. So so unfortunately, I think that like I said again, hard times seem to be coming, but we'll see. Maybe we'll find a miracle solution to that. This week we do have non-farm employment change, unemployment rate, and ISM manufacturing and average hourly earnings. ISM is tomorrow, and the rest are on Friday. I do think the markets are going to pay very close attention to non-farm employment change. Now, ADP's numbers are based on ADP, which of course is probably the biggest payroll processor of them all. So they probably do have a good idea. So if the numbers match, non-farm employment change matches what non-farm employment change says for ADP, then that would be a good gauge that, yeah, things did slow down. Unemployment rate, I do think that's going to have an impact too, because if we don't see unemployment rising, then that means the Fed has more reason to keep going, doing what they're doing. So basically, if unemployment drops, that's not a good thing right now for the market. It would have been good when the Fed's easing, but now it's the complete opposite.
I always find that so fascinating, right?
Right.
When it's like, oh, we need less people to work because the market, right? And for me, being in, in the markets for so long, it's good to get your perspective, because then when news comes out and you're like, well, I thought that was bad, but the market is rallying. It's always taking this perspective
Right.
and all applying all this information. So
Right.
that kind of covers some of the things in the news. So let's get into the juicy stuff, right? Like, part
Yep.
of the reason that we do the show is because there are all these things taking place in the world, but we're trying to find opportunities. We're trying to find diamonds in the rough, and that is what the Madison Trading House software allows us to do as traders, as investors, as analysts. And so in this part of the show, we'll go over a couple of different names. And so I'm very interested in this first stock that you pulled up, or that you that came up on the
Hmm.
scans,
Hmm.
and that's ChargePoint, and that's
Yes,
I'm assuming a company that's kind of involved in charging electric vehicles. Am I correct?
that is absolutely correct. Um, so basically, ChargePoint is involved. They provide EV charging for North America and for Europe. Um, Now, I admit my EV terminology for charging stations is a little weak because they've a lot of things have changed over the last few years. But bottom line is they're a provider of that service. The machinery looks like. So what we found is that they saw a 100% year over year third quarter growth.
Woo.
Um, well, actually, sorry, they forecast a 100%. Excuse me, they forecast a 100% year over year Q3 growth. So they just report for Q2, but what they're telling everyone is, come Q3, we expect a 100% growth. Now, by any standard, that's big. That's a really big improvement. And of course, EVs are hot. I mean, it looked like for a minute they might cool off, but no, this is a trend that's not going anywhere. I mean, now you have Dodge, which is offering the new Challenger as an EV, and I'm like, that's I mean, if you think about muscle car EV, I mean, I heard it rev, and it sounds kind of weird, but the point is that's the direction things are going. Um, so EVs are going to be more prevalent. You have California basically saying that they will no longer allow gasoline vehicles to be sold. What's the date?
New
20.
2035 new vehicles to be sold.
Yeah, that's right. Right. So new vehicles, right. So even though that's a ways off, that is a huge deal because you're basically saying 12 years from now, roughly, no one's going to be able to buy a brand new gasoline powered vehicle. And a lot of companies are discontinuing their gasoline powered vehicle lines. Ford, for example, basically sells the Mach E Mustang. They still sell the regular Mustang, and they have a Bronco, and they have the trucks, of course, the F-150s, etc. But other than the pickup trucks, which I usually think of a different category of vehicle, when it comes to just your regular sedans and things like that, they basically have greatly diminished your product line. And they're not the only ones doing it. Cadillac basically is made a very clear move in that direction with their SUV EV. So I think that this trend is just going to keep gathering momentum. Now, I will divert. I'll divert for just a second on that topic and just say, just for the record, I don't think that EV vehicles are the solution they're presented to be for all the reasons. That it's not. They're very labor intensive. Resource intensive to build them. So we haven't solved that problem yet. So I don't see, like, 5 years from now everyone's got an EV vehicle. I just think that as a subset of the marketplace for vehicles, I would definitely see EVs being at 20% over the next 10 years. They should be at 20% of the market or more. Now, once we get to that point, obviously that drives up cost for different things in that space. But if you're a charging station, you can't really lose if you're selling, as long as you don't have too many competitors to knock you out, people are going to need to charge their vehicles. The more of them there are, the more charging stations you can build. And a lot of people don't drive their EVs out of urban areas or suburban areas because they don't know where to find an EV charging station. But the more of them there are, the more people may travel around. So I do think, and with the advances in batteries where you can charge faster and go farther on one charge, a quick charge, I don't see any reason why this won't be a growing trend. So
Real
charge point
quick,
seems to be. Oh,
real
sure.
quick, Mike. I just looked up the stats on the percentage of electric cars
Hmm.
as a total of 2022. It's 5%. So right now, 5% of
Yep.
vehicles are electric.
Which is huge, by the way. I mean, for those of you listening, that's big. 5% is a big number. I do think we're going to hit the 20 percentile for two reasons. Again, one, because there's just a big push for it, but also because companies are really changing their product lines to have more EVs. Like, they're very. I'm trying to think. Is there any company that doesn't offer an EV vehicle at this point? Any major company? I'm not sure, but I'll check later. But I think almost every major manufacturer that sells in the United States offers an EV vehicle at this point. So that's the direction I believe things are going. So I definitely see ChargePoint as being one of those companies that could do
So
really
so
well.
what's the AI telling us? Because I think our viewers are saying yes, yes, yes. You're right, Mike. There's going to be a demand for these things.
Right,
But
right.
is this the stock that I want to be owning to make
Okay,
that play, to get into that?
great question. Okay, so technically we don't have much to say because the stock ultimately has been flat between basically 14 $18 for the last month, which is not a big deal. That's just saying we're still in the same range. So in the technical score, we can't see anything really positive. But when we look at the other stats, they're mostly neutral, but let's go through them one by one. Okay, first we're going to look at the inner circle. We go here to kind of figure out what people are doing. Right away, I see a stat that I like. Institutional ownership is 50% of this company. That's a good sign. Institutions are committed buyers. They don't go in and out. If they like you, they stick around. So if half of the shares out there are owned by institutions, good sign. That's probably a company that's going to be around for some time. Also, institutional ownership is up 4.69%. Buyers are up by 68. Sellers are down by 44. Now it's in one more top 10. So that's a good sign. That means this is a company that is attracting investors, long term committed investors. They tend to put a floor on prices. So, therefore, if they're interested in buying, good. Now, on money flow, we're not seeing positive over the last 5 days, but there's no surprise on that. Pretty much most stocks I'm going to look at are going to show negatives over the last 5 days simply because the markets have been down after what Powell had to say. But that should mitigate itself later. So, for that reason, we get a neutral score presently, but I would only pay attention to the institutional side given the market context. So as far as the algorithm is concerned, it does see strong institutional buying, puts it in green. So we'll go from there. Next, we'll look at valuation. Valuation is basically in the middle of nowhere. Price to book is neutral. This does have a good beta score. Alpha, these are both good, both in the green. Price to sales is actually in a very good spot, price to sales. And sales, by the way, are more important. Like, if you look at PE ratio and things like that, this company, let me see if they actually are making any money yet. Let's just find out. Let me go to valuation or fundamentals. So no, they're not, as I expected. So this is not a profitable company yet. That's not something that I would worry about because generally speaking, startups are not profitable at first, and this is a really early phase of a new company. So we don't even have earnings going back more than this year, basically. So far they're losing money, but this is a normal pattern. The pattern we want to look at is sales growth. That's what we want to see, and this is doing exactly what any good company that's gaining momentum does. It shows a sharp increase in sales, which is why we got green on the growth. Key ratios have green. Profitability, like I said, they're not making money, so we can't give them a green on profitability. They're losing money. But when we look at the analyst estimates, the lowest estimate is $12. The median is 24, which is about $8 higher. All right, so basically this says we got about $4 of downside versus $8 of upside on average, the highest target being 46. We also see a projected earnings improvement in 2024. We do see that earnings are expected to drop in 2023, but again, we got to think about this like we would Amazon and Tesla back when they started. No one's thinking about the fact that they're not making money now. At least investors don't. This is a big difference between investors and everyone else. Investors see future value. They don't look at what's happening right now in terms of the numbers. They look at where the numbers are heading. So companies like this have to keep reinvesting whatever they make, right? So they bring in money, then they spend it to reinvest into their business. Okay. So in short, that reinvestment is what's going to bring us better, you know, future growth. So when I look at fundamentals, which was where we just were, we still have a yellow score, so everything's neutral on this, but I wouldn't take that negatively because eventually these numbers are probably going to go green. I would pay most attention to what the institutions are doing, they're buyers. So we want to focus on that. And we want to focus fundamentally on the fact that we have some good growth potential. So, in short, the algorithm is not saying you have to rush in the door to buy this right now, but if you're a longer term player, the algorithm is basically giving us some good positives that we can work from. And as long as we just focus on that, things don't look so bad. I would also say that looking at the technicals on the Madison chart, which is right here, I do think right now we're about to top out on the upward movement. So don't. So if you're looking to buy exactly at this moment, you can probably afford to wait. We'll probably get a second chance to buy at the same price later. So for now, just kind of hold off. Just wait for it to get into the exact right place and time. But I do think long term this will be a good buy based on all the information I'm gleaning from the algorithm. So it doesn't look so bad.
Yeah, and the fact that there's not going to be any gas-powered cars, and you're going to have to go charge your car somewhere, and those things don't exist yet. And so, I definitely like the investment play here. I just added it to my watch list. This is an exciting one. Definitely going to keep an eye on it. All right, moving on to our next name. It's staying on the topic of China and the goings on of
hmm
that nation. Our next title is Baidu, and if I'm not correct, it's considered the Google of China, right?
Well, Baidu does okay. So, oh, sorry, let me jump to Baidu. So, interactive media. If I go here in the sorry, right here, Baidu is the largest internet search engine in China with 84% share of search engine market in September. Yes, so they are the Google of China.
So they got 84%, not like the 98 that Google has.
No, yeah, they're not quite Google level yet. But yes, by the way, folks, this is an easy way to know about a company. This is one of the best features of the platform. When I go to my dashboard, it already tells me what they do, what sector they're in, where they're listed, their website, and I can also literally just put my mouse right over the name and it tells me exactly what, a detailed explanation, summary of what they do. So now I know. So Baidu search engine. It says here, is reading on another screen. Q2 results narrowly beat expectations as cloud business grows. Nasdaq listed Chinese tech group sees no hurdles in converting to primary listing in Hong Kong. And they had a 31% jump in its cloud business that offset slowing online ads for China's largest search engine. Now, this is a very important point because we keep seeing this repeating. uh, we're not seeing ad revenue as high, which basically means businesses are not advertising as much, which basically means things are slowing down. Okay. So that's what we see there. They did say their cloud services went up, which kind of offset some of those losses. So when we look at Baidu, technically it's not bullish yet because it's only been going in the same range between 126 and 149, but it's starting to go up. Now let's look at the other factors. Institutional ownership is actually down. And even though this last earnings report does show some growth in their cloud business, we got to wait to see if we actually see some increased institutional ownership. We're only at 25.68%. So this is not a heavily institutionally owned stock, which means it's going to tend to be more volatile. The more institutional ownership a stock has, the more stable it tends to be, and the less it has, the more volatile it tends to be. As average people have very different opinions, but institutions usually look at the same factors. So, in short, we do have more buyers and fewer sellers, but this is on zero top 10 list at all. Not a good sign. Money flow is not so good recently. We don't have insider information here because of China's policies. We don't actually get to see as much internal workings as we would in U.S. companies. They don't have to report as much. So in short, Jumping to valuation, price to earnings ratios, etc. Um, they don't look. The forward PE ratio looks good for what they're projecting, but the current PE ratio does not. It doesn't look so good. Price to earnings growth is in a good spot. Price to book is in a good spot. But realistically, the numbers don't look so good. Beta is kind of low. Alpha is low, meaning that's not performing as well as the rest of the market in the US. Price to sales is in a decent range, but price to cash flow is really high. On the fundamental side, we do have projected targets that put it at 215. So that's a good sign. The lowest downward target is 138. So that's not so bad either. But sales growth looks like it's fairly flat. We do have a lot of missing data here, but again, this has to do with how China functions. For a good period of time, we had a lot of these companies there. There was a possibility of them being delisted. So there's a lot of missing data that we can't get. So in short, the algorithm is showing a pretty mixed bag on this one. Fundamentally, like I said, it doesn't look so great. Even though the targets are here, we don't have the data to back up the reasons for that. So therefore, I would suggest not being too keen about getting into this stock right now. Um, on a technical basis, it's flat. It does look like it may have a little bit of upside potential, but when I zoom in, I mean, it doesn't look all that impressive. Just looks like we're just going sideways, not really figuring out where we want to go. So this one, I would say, based on what the algorithm is showing, it doesn't look like this is that promising at the moment. If we start to see that change, great. I would at least want to see mostly yellow. I mean, the technicals are fine. If it's in red, doesn't really matter. But if I see the bottom three are not at least yellow, probably not a good buy. So I would skip this one for now, even though it's having a good day today. It doesn't look like it's going to be a winner at this point. But if you keep an eye on it on a watch list and wait for improvements in these, then great. And if you don't want to keep it on a watch list, you can always use the screener to find stocks that have had recent improvements in these values. That would be an easy way to find it. So if Baidu happens to be in that list, then that would be the best time to look for a buy.
Yeah, it's interesting to see when you load in some of that like inner circle data, how it's like missing and choppy. So,
Y- Yep.
I think the software does a good job of, hey, if it's there, we'll get it. If it's not there, these are just the things that U.S. investors or international investors have to deal with when you're working with Chinese companies and Chinese names,
Right.
which leads us to our next ticker symbol, which I think is another Chinese company. I had to look it
It
up
is.
because I've never heard of this company. And I actually had to pull up the site because I don't even know what it is. But
Yeah.
ticker symbol PDD, Pin Duo Duo. Did I say that correct?
Yeah, you did. I think I don't know how to say it either. Uh,
So
so,
why did this hit the watch list?
well, because of its movement, it is a strong mover. I've been watching this for a while, actually. So, PDD has been on the watch list multiple times, mostly for technical reasons. It's just been a top performer. Right now, it's on a pretty good run up. Earnings have been good multiple times in a row on this stock, by the way. It has a lot of green E's, like one, two, three, four, five, six in a row. So this is doing pretty good on earnings so far. So what are they? Is the question. Well, what they do basically is they provide a platform that connects consumers to farmers. I mean, that's what they said they do. Now, I'm not sure if that's the only thing they do, but they seem to focus on agricultural stuff. So I'll just read the description. Is the third largest e-commerce platform by gross merchandise volume and the largest platform by active buyers in China. Let's see, it is one of the top two players in next day grocery self collect services, similar to community group purchasing, where groups of consumers place fresh food and grocery orders online and collect designated self collect collected points the next day with the help of group leaders in the community. Okay, so that's a little confusing exactly what they do, but apparently it's popular in China. They're actually seeing good growth. So it does involve groceries. I don't know if they do other things too. Clicking on their website, there it is. So I do see a lot of stuff there, but then I do see groceries too. So
It kind
apparently,
of reminds me of Alibaba a little bit. How it's the connector of these wholesale, manufacturers, but are agriculturally.
yeah. So I don't know. Like I said, I don't know everything they do, but I do see that according to every report I've read, their mainstay seems to be in the agricultural side. The food side seems to be where they're making their money. Now, looking at the numbers, technicals I will ignore for now, and it's starting to go up, so that will get a green score pretty soon. This is the one I like to look at right now. In the inner circle, we are seeing that institutional growth. We're seeing 1.21% increase in institutional ownership with 93 more buyers, 65 fewer sellers, and 13 more top tens. This is one that definitely is liked by Wall Street. Money flow is actually positive on this as well, which is a little surprising given that most stocks are getting hammered. This one has been doing pretty well. Looking at valuation, valuation looks like a mixed bag. You've got some greens, price to book value, projected price is green. They're actually expecting well, let's see, earnings are negative, but let's see, P ratio. Yeah, I have to enter a growth rate in this, but I believe I know why it's giving a green there. But alpha is positive, beta is lower, so that means it's not a stock that moves as much as the rest of the market. Does Is not as volatile. But alpha means that you are gaining, you're improving, your performance is better than the rest of the market as far as actual gains. So low volatile stock with better gains is not so bad. P ratio, not so good. Let's look at the fundamentals on this and see what we see there. This actually I like. You have negative earnings in September, et cetera. Then we keep seeing consistently better earnings than expected. That green line that's pointing up means that the earnings came in better than anticipated. So consistently, they're beating expectations recently. That's a good sign. Also, 2022 is expected to be good, and 2020, or sorry, the next 2 quarters are expected to be improving. Now, what I don't like is projections. We're currently trading right at the projected middle price. So the only thing we got left is the highest estimate. So that means that at the moment, if we were to get into this stock, we actually shouldn't expect it to go much higher than where it is now. It could, but we shouldn't expect it to based on the analysts. But if I look at everything else, profitability is improving. That's a good sign. Cash flow is improving. That's a good sign. Key ratios are mostly good. Sales growth is definitely up, but it's flattening out. And we do see positive income presently. So the company looks like it's going in the right direction as far as its business is concerned. It looks like it's actually gaining momentum. So I would say this does look like a good stock. And if I'm looking at this history of earnings, a year by year, clear improvement. So they're definitely on the right track. So this one to me looks like an attractive stock to be in. It's just in the near term, we don't have much upside potential for it. So if I look at it on a chart, all of that would tell me right now is that it's probably not in my best interest to buy exactly where it is now. I would expect it to pull back below $60, most likely back into the price range of around was that $57 or so. So we'll probably get the stock pulling back after this run. I would say this one looks like a reasonable stock to invest into, to hold. I don't think it shows much reason to expect short-term momentum, but we'll see. So we had the move up now. We may still keep going, but I would not expect that this is going to take off. I think this is going to be more of a trade up and come back down and then eventually go up later on. Hopefully we get a run like this one. That was a epic run, so we probably could get one at some point. But for right now, I would just say it's reasonable to buy this. Just be prepared to hold for a while. And I would definitely say target a lower price. You should be able to get this under $60 if we wait maybe a month.
Great name to put on the watch list if you're liking China, you want to get in on China. I think you touched on a lot of the good rationale behind it. Definitely, the institutions are a sign of big players, big money coming in. So, with that, let's go ahead and just throw out to everybody an invitation to the software, right? So, if you're liking what you're seeing, if you're appreciating Mike's insight, if you want to have a copy of Madison Trading Software for yourself, go ahead and head on over to MadisonTradingSoftware.com, download, sign up. Someone will get in touch with you, get the demo. It's web based, right? So you can use it on your Mac, you could pull it up
Right.
on your phone, you can put it
Right.
on a PC. Very user friendly. And if you're following the show, you'll definitely see different segments of Mike going in and using all the features. But with this current offer, Mike, you do have something special that you're brewing up over there. Do you want to tell everybody about it?
Yes, we do. So I did mention in our last podcast that we have our boot camp. So we've set our date for September the 17th. Firstly, I want to thank everyone who signed up. The first 30 spots went very quickly. So we decided to open up an extra 10 spots for those of you who haven't done that yet. So make sure that you register for that. It's MadisonTradingSoftware.com/bootcamp. Go ahead and register for that. We'll have the first one, the next one's coming up September the 17th. And then after that, we'll probably schedule another sometime in the future. Now, when you go there, what you're going to learn how to do is use the Madison software. Now, everyone can see in the podcast all the different benefits, but what this will allow you to do is learn how to master the art of using this so you get maximum efficiency. You can find good stocks to invest into, effectively know what I know, like what to look for, how to evaluate an opportunity, and use the software for those purposes. So this will be your excellent opportunity to get used to the software, but also we're going to go over basics of stocks. We're going to talk about supply and demand, risk management. We're even going to get into options. A lot of you have told me you haven't learned how to trade options yet, so we're going to go over that too. So guys, 10 seats left for September the 17th. Looking forward to seeing everyone there. It's going to be awesome. And it also will give you the ability to get access to the software as an added bonus as part of the package. So go ahead and do that. And we'll see you all there.
Yeah, highly encourage everybody to check that out. I've gone ahead and added the link to the chat. So if you want to grab that, it's MadisonTradingSoftware.com/bootcamp. And I know that personally, since I've started using the software and being in there, when I see an opportunity or I think of an investment, my mind automatically shifts to this. Okay, well, how would Madison read this, right? Like,
Right.
what are the institutions doing? What is the money flow looking like? What are the projected earnings? And I think that's one of the most powerful pieces of the software. And so, if anyone is serious about improving their trading game, I would highly recommend you head on over, grab one of those last seats, and really get an inside look into how to successfully invest, how to improve your trading. So, with that, the links are there. Everyone, go ahead and head on over there. Mike, we've got the Labor Day weekend approaching us. Anything you heading out to Vegas, or what's on your radar?
I'm not heading out to Vegas, but basically, I'm just going to relax. That's it, man. I'm just going to kick back. I'll probably go to Michigan to visit some friends. I usually do that on holidays. I am going to be busy because I am moving next week to back to the South Loop of Chicago. I've been living here in Pilsen for well, I'm not. I'm in the office now downtown, but I've been living in Pilsen for a while. But decided to move back to South Loop. So if you're back in town, definitely visit the new crib. See, it's going to be fun. But other than that, guys, a lot going forward. You're going to see me doing a lot of content from my new crib since it's set up. I want to be setting it up for a studio at home. That was one of the main reasons I want to move, just to have a better layout for that. But it's going to be cool. So
I'm
Looking forward
almost
to it.
jealous because I'm in my home studio and I'm like, oh, I need a reason to go to an office or something. So in a way, I'm jealous. But all around, I think September is shaping up to be quite an exciting month on many fronts. A lot of people getting back to business. So
Right.
yeah, I think I'm gonna go ahead and relax a little bit this weekend too, and highly encourage everyone else to just get your mind right because there is going to be a lot of opportunity in September, and we want everybody to take advantage of that.
Oh, one
Um,
other quick thing, folks. I'm going to be flying to Minneapolis today. I always say Minneapolis, Minneapolis today. We're going to be meeting with a client. He's doing a program that we do as a special for certain members. It's limited availability, but we actually go to visit them and we do training in house with them while the markets are trading, looking for trade opportunities, etc. So really exciting stuff. You will see some video about that later that we'll publish to our sites. So stay tuned for that too.
and does that mean that after you have a successful session, you go ahead and hit the town?
Yeah, usually. Yeah, usually we do. I mean, that's the norm.
All
So
right,
it's a lot of fun.
Minneapolis, watch out. Mike's heading there for the rest of the week. All
All
right,
right.
Mike, thank you for your time. Thank you, everybody, for tuning in. If you've enjoyed the broadcast, hit that like, hit that follow, hit that subscribe button. If you have any questions, feel free to drop them into the chat, leave a DM. Someone will get back to you. We're all about helping each other, and improve our investing. That's why Mike created the software. That's why we do the show. Help us help you. That's kind of what we're trying to do here. Mike, thank you for your time. Thank you, everybody, for tuning in. We'll catch everybody next week.
All right. Take care, folks.